Traditionally, the road to financial freedom takes 25 to 30 years. But what if you could do it in 6 to 7 years? Keep watching to find out how I'm going to reach financial freedom in a fraction of the time. Let's start by talking about the retirement myth and the real problem. Now, traditionally, retirement takes 30 plus years of consistent saving and investing. And many people will recommend investing in growth stocks, such as Microsoft at $524 per share, and things that have exposure to the S&P 500, such as VU and SPY. Now, the median household income is listed at just under $75,000 for the middle class, which means that after rent and food and other large expenses, it's hard for many families to have an extra $500 to invest in the stock market. And so sometimes you'll meet people who do own things like Microsoft or VU, and they will be up 4, 5, 600%, but they only have 8 to 10 shares. And so for them, it's going to take them a lot longer to achieve financial freedom. So, contrary to what many people believe, the primary problem with growth funds is not time. The primary problem is the speed of capital accumulation. And so I think that's why people who are in the FIRE community really understand that they just need to save more money or cut expenses. And so you might hear people online say, you're not going to retire from your salary. And I think that's just such a simple way to put it. If you have a higher salary, you have more potential to have a higher initial capital to invest in the stock market. So having a high salary actually might help you retire earlier. Now, people in the FIRE community will have a scarcity mindset and a hustle culture mindset. And so they'll work extra jobs or move to a country that has a lower cost of living. But what if you didn't have to actually do that? What if you could build your capital not by working harder, but by making your money work smarter? Well, welcome to my Dividend FastPass strategy. Now, I came up with this strategy after waiting in line at an amusement park. And I'm sure many of people here who are watching the video have went to Disneyland or Disney World or Six Flags or some kind of place where you need to wait a long line. And you see other people who have bought this membership or some kind of fast pass where they skip the line and they get on the ride earlier. And so this is where the dividend fast pass strategy was born from. And so this dividend fast pass is supposed to help people get ahead of the line and not have to wait 30 years, but maybe they have to do 6, 7, maybe 8 years. And there are two parts to this strategy. The first part is the first stage, and that's something to do with capital accelerators. And the second stage is growth reinvestment. So let's start off by talking about capital accelerators. Now, the government and institutions have long wanted to give more access to income to the public. And so in the 1960s and 1980s, REITs and BDCs were created to do just that, give more access to income to people. Now, fast forward a couple of decades later, we have high yield stocks. Think AT&T, or think of stocks that have exposure to energy and pipeline and oil or materials. And you'll see that these dividend yields during those times was anywhere from 6 to 8%, which was considered really high yield. Now, recently, we do have things like cover called ETFs. And I remember my first cover called stock, it was QYLD, which at that time, people were raving. They were like, wow, this is how I'm going to retire, just by putting it all in QYLD. Now, more recently, we do have something called JEPP and JEPQ, and the same thing. People think, wow, I'm going to put all my money here, and I'm going to be able to retire. But the landscape is continually changing and innovating. And when I look at the yield max funds, in particular YMAX, we can see that this cover called ETF is really, really beating other popular funds. And I know people say, okay, isn't there NAV erosion? But if the argument is total return, then YMAX is a clear winner, and it's beating a lot of popular funds such as Realty Income and ARCC, which is a BDC. Now, if you were an investor 10, 15 years ago, a lot of people were raving about REITs such as O and BDCs such as ARCC, and they're good funds, and I've had them in my portfolio at one point. But I think because the landscape has innovated so much, there are better capital accelerators in the market. And in the next few months, the next few years, there's going to be even better capital accelerators. Now, if you're curious, YMAX is also beating JEPI. And YMAX isn't even the best fund that YieldMax has. But a lot of people like YMAX, including me. So using high yield or high dividend payouts to buy more growth assets is one of the primary strategies of this strategy. Now, for many people in the high yield space, they'll usually start by reinvesting for income. And how do you do that? Well, you generate income and then you either drip or you buy other high income assets and you are continually buying more income. Now, that is an initial strategy in this dividend fast pass strategy, but it's not the primary strategy. The actual strategy or primary strategy is to reinvest for growth. And I think if you generate income and buy growth assets, that will really impact compound action. So instead of having only 10 shares that are 2,000% return, you'll have a 2,000% return on 500 shares, which I think will really change your portfolio, or will change my portfolio from a linear growth pattern to an exponential growth pattern much faster. And let me give you an example. Now, you've probably seen this chart, and in traditional investing, somewhere between year 20 and year 25, compounding becomes more visible, right? Until that time, it just seems like your portfolio is really linear and not making any big changes. But exponential growth or compounding really happens after year 20. And if you look at my example here, going from 720K to 1.2 million in 5 years is such a big jump, right? But many people will say, well, I don't want to wait 20, 25, 30 years. But what about 5? Could you wait 5 or 6 years? And for me, I think I could, if that really meant that I'd have more durable dividends, I'd reach 1 million or more dollars in principal, and have a pretty good dividend payout. Now, this is just based off of today's instruments and securities and cover called ETFs or high yield instruments. There might be something down the road that's even better, because remember, the high yield space or capital accelerator space is continually innovating. But for now, let's look at how I'm going to implement my 7-year FastPass plan. Now, in phase 1, which takes anywhere between 1 to 2 years, the goal is aggressive capital accumulation, and this will result in generating significant passive income. Now, this could be shortened or reduced. If you have a higher, larger starting capital, like if you're an engineer and get paid 200-300K a year, this is phase 1 is not going to be that long. Or if you're leveraging margin, which I don't recommend for new investors, but if you know what you're doing, then margin might help, reduce some of this time in phase 1. Now in phase 2, which takes 3 to 7 years, the goal is growth acceleration and transition, and leverage income stream to build a growth portfolio. Now, if I give you a few examples of funds that will be in phase 1 and phase 2, in phase 1, I have YMAX and Ulti, and XCTE and YETH. Now, these funds could change depending on the landscape of capital accelerators, but for now, I like YMAX and Ulti. There's still a lot to prove, but in the last few months, it has been consistent. So if you look at YouTube, there's a lot of people promoting Ulti, and so I do have a small, position in it, and I'm monitoring it every week to see if it stays in my portfolio or if there's a better capital accelerator elsewhere. I do have higher convictions for XDTE, and YETH is also something that I've considered and am building as I get more data points on it. Now for phase 2, which is the growth fund phase, I have SCHD, which is a popular fund in the dividend investing or dividend growth investing community, and a broad market ETF, which is SCHB. I also have SNSXX and a high yield savings account, which is more for capital preservation than anything else, but they are part of my phase 2. Now, I have SCHD and SCHB, but these could easily be switched out for something like FDVV and maybe a fund from Vanguard or Fidelity. Okay, but I just chose these two because I have Schwab, and right now these funds are at a relatively low buying point where I can buy a lot of shares at a sort of cheaper price than I could buy FDVV or VOO, right? Now, here are some crucial considerations. This is not a set and forget type of strategy. The high yield space or the capital accelerator space does have juicy yields, but some of them are high risk. Okay, so some of them have a lot of NAV erosion, some of them have a little bit of NAV erosion. So some of them have 85% yields, and some of them have 30 to 40% yields, which is usually the funds that I target. So this is a strategy that you need to really monitor, or at least I need to monitor weekly, if not a couple of times a week. It's not something you could just turn off your phone and look at it again a month later. Now, there are tax implications for this dividend strategy. If you look online, there are a lot of things with return on capital, which is ROC. There's a lot of things with calculating taxes in certain countries. If you live in Belgium, the relationship between stocks and tax is different than it is in the US. Now, if you have a Roth IRA, then you can avoid a lot of these tax problems. But the problem or challenge with the Roth IRA is there's a $7,000 contribution limit, and you can only put in earned income that you made in the US. So you can't put foreign earned income, and you can't put income that's derived from dividends because that's not earned income. Okay, so Roth IRA to me would be the best way to implement this strategy, but there are some challenges with capital. Now, I think diversification is also a key part of any strategy, and some of the single stock cover called ETFs or high yield leverage instruments can be quite dangerous and sometimes a double edged sword, with the blade facing you more sharp than the blade facing the other way. So you have to be really careful with these single stock or leverage funds. I usually recommend sort of a basket of funds, things like XDTE and YMAX and even Alti, because although there's some NAV erosion and risk, because it's more diversified, to me, they're generally a little bit safer than other funds. Okay, so that was just a short episode, episode number 1 on my dividend FastPass strategy. In the coming episodes in this series, I'm actually going to show how the funds are progressing, how much income they're generating, and how I'm reinvesting the income into growth funds. With that said, I hope you liked this video. If you did, please drop a like. If you want to follow my journey, subscribe to the channel. And I hope to see you in the next video. Take care.